this week's market update, should it be buy or sell in May this year? With one leading investor suggesting markets are on the brink of a melt up. Plus, central banks are in focus as both the Fed and Bank of England decide on interest rates. Earnings season continues with Apple and Alphabet in the limelight. And a flood of US data builds on last week's better than expected GDP figure. Well, this is the time of year when investment writers fall back on the easy option of discussing an old stock market adage that's known colloquially as sell in May. The full version, you'll probably already know, is sell in May and go away, don't come back till St. Leger Day. St. Leger Day refers to a horse race in September and traditionally marks the end of the summer social season in the UK. So the adage is a comment on the relative performance of stock markets between May and September. As the saying suggests, this is often the worst part of the year. The message is this: if you're going to be out of the market at any time, then the summer is when you're least likely to regret it. No one really knows why shares should perform less well in the summer months, but there's certainly some evidence that this is the case. Whether investors should give it a second thought, however, is less clear. There are lots of reasons to ignore sell in May. As an investment strategy, it's less than helpful. That's because even if share prices do underperform over the summer on average, there's no way of knowing from one year to the next whether it will make sense to follow the adage in any particular year. Secondly, history suggests that stocks outperform over the long run. Most investors are better off buying and holding to benefit from that outperformance. Finally, frequent trading is expensive. Costs can fritter away the long-term advantage. The odds on sell in May working in 2019 are particularly hard to call. On the one hand, stock markets are flying high. The S&P 500 and Nasdaq hit new records just yesterday, and we've been in a bull market for more than 10 years now. On the other hand, however, the backdrop still looks positive for shares. First quarter earnings season has started off better than expected. The jobs market is in good shape, and the Fed has reverted to an easy policy bias in response to the market wobble at the end of last year. Add in more positive signs on the trade war front, and it's perhaps unsurprising that investors have got the bit between their teeth again this year. Or, as Larry Fink, the boss of BlackRock, said recently, we have a risk of a melt up, not a meltdown here. His argument is that many investors have not yet participated in the rally that has driven prices higher in the first quarter of 2019. He sees record amounts of money parked in cash and still high levels of outflows from equities. Were sentiment to continue improving, he believes shares could rally further from here. History suggests this is possible. Stock markets rose strongly at the end of the 1990s bull market as investors who had missed out belatedly jumped on the bandwagon. It's not unreasonable to think that the current long bull run could end in a similar fashion. As we've seen, companies are starting to see opportunities to raise serious money at today's buoyant stock market prices. The latest high-profile company to confirm it's tapping the public markets is Uber, the ride-sharing app, which has transformed the way many people move around the world's big cities. Last week, Uber said it's looking for a $90 billion valuation when it floats in the next few weeks. That's a little below the $100 billion that had been expected, reflecting the lukewarm market response to rival Lyft's IPO. After an initial spike higher, Lyft shares have fallen back below their flotation price. But Uber will still be one of the biggest new issues ever. It will raise around $10 billion of new money. Uber is a controversial business. It's disrupted the traditional taxi business and become a part of daily life for many. But its internal culture and treatment of its drivers has been criticised. Above all, from an investor's perspective, it continues to burn through cash and has never made a profit. Investors who remember the dot-com bubble 20 years ago may be forgiven for thinking that history is repeating itself, sucking investors into a compelling technology story that doesn't stack up financially. The counter-argument, made so convincingly by the likes of Amazon and Google owner Alphabet, is that early-stage losses can set the stage for subsequent market dominance and sky-high profits in due course. Alphabet actually reported its first quarter results last night, and they were very strong. Revenues rose by 17%, a huge jump when you consider that sales were over $36 billion in the first 3 months. However, Alphabet shares fell 7% as even that figure was slightly below expectations. That's the risk of the high-flying tech stocks. They're great growth stories, but the market has already priced that in and is impatient of the slightest sign of a slowdown. Also in the limelight this week will be Apple, and these two fangs are the highlights of another busy week for first quarter earnings. Other companies in focus include BP and Shell on this side of the Atlantic, together with General Electric, McDonald's, Merck and General Motors over the pond. With Volkswagen and Adidas reporting too, there's also plenty for European investors to watch. So far, earnings in the US are running 3.9% lower than a year ago, according to FactSet, which monitors results announcements. That's a fraction better than recent expectations, but still arguably sets the market up for its first earnings downturn since 2016. And if the second quarter is weak too, the first earnings recession since the financial crisis. For investors watching the macroeconomic picture as well as company results, there's also plenty on the radar this week. The highlight will be Friday's non-farm payrolls data, with another 180,000 jobs thought to have been created in April, helping keep the unemployment rate at a historically low 3.8%. In March, 196,000 jobs were added. Other data this week will include US car sales, home prices, manufacturing numbers, and consumer confidence. Also worth keeping an eye on this week will be the latest US-China trade talks, which will see US Treasury Secretary Steven Mnuchin and Trade Representative Robert Lighthizer flying to Beijing for further discussions. Talks are thought to be in the final stretch following Donald Trump's decision to postpone a planned increase in tariffs from March the 1st. Mr. Trump is also continuing to have an impact on the oil price. The cost of crude had soared to a multi-month high recently after the US said it was ending a waiver that allowed a number of key oil importers like China and India to keep buying Iranian oil despite the imposition of sanctions on the country last November. Those restrictions have already seen an estimated 6% fall in economic output in Iran, but the US is determined to squeeze the country further in a bid to neutralize its alleged interference in the rest of the Middle East. Blocking those sales has threatened a supply shortage and pushed the price up to around $75 a barrel, 40% higher than at the start of the year. But a recent tweet from the president calling for a lower price was a reminder of the leverage the US holds over key exporters like Saudi Arabia, and the price has since retreated to around $72. And finally, tomorrow sees the start of a new imperial era in Japan, the first since the current emperor began his reign in 1989. Emperor Akihito will hand over the reins to his son, Crown Prince Naruhito, after becoming the first monarch to abdicate in more than 200 years. Dubbed the Reiwa era, which means beautiful harmony, the new period will not necessarily mark a change in direction for Japan, as most people expect him to build on his father's legacy, and the emperor's role is mainly ceremonial. But as an international figure educated at Oxford, he can be expected to support the reforms that have been initiated by Prime Minister Shinzo Abe over the past 7 years. Investors will also hope that he presides over a kinder period for the markets. Emperor Akihito's reign began close to the peak of the 1980s stock market and real estate boom in Japan, and the past 30 years have been challenging. The Nikkei index remains little more than half its level in 1989, and property prices have slumped. Back then, it was estimated that the land on which the imperial palace stood was worth more than the whole of California. Japan faces many headwinds thanks to a fast aging and shrinking population, but it remains one of the world's biggest economies, and its companies are leaders in high-tech areas like automation and robotics. It's apparently defeated the deflation which has haunted the Japanese economy for years, and its jobs market is tighter than it's been for decades. Wages and consumer confidence are rising. Above all, its stock market is no longer a byword for high valuations, but instead has become one of the world's cheapest. Investors will be hoping that some of the beautiful harmony rubs off on their portfolios.